If you've been looking into real estate for any amount of time, you've probably seen what feels like 100 different ways to make money. Wholesaling, rentals, flips, tax liens, creative financing. And after a while, it all starts to blur together. You start asking yourself, which one am I actually supposed to do right now? Well, here's the truth. Most people don't fail because real estate doesn't work. They fail because they chose the wrong strategy for the market they're in. Because real estate doesn't move in a straight line. It moves in cycles. And this is where most people get stuck. They learn one strategy from one guru and then try to force that same strategy into every market. But professionals don't think like that. They understand multiple strategies, so they can capitalize on the opportunities that show up in each phase of the cycle. Real estate usually moves through 4 phases: expansion, peak, contraction, and recovery. And every phase creates different opportunities. Flips can thrive. When things tighten, wholesaling and creative structures become stronger. And when prices reset, rentals become more attractive. The people who win long-term don't know just one strategy. They know when to use each one. So let's break down the 5 core strategies. First, wholesaling. This is usually the fastest way to generate cash. You simply find a deal, put it under contract, and assign it to another investor for a fee. Now, this is best for people with low starting capital, plenty of time, and strong lead generation energy. And it becomes especially powerful during contraction and uncertainty. When buyers get cautious and sellers get motivated, deal finders win. Second, rentals. This is a long-term wealth builder. Cash flow, appreciation, principal paydown. This is where stability compounds. Rentals tend to shine during recovery and stabilization. When prices start making sense again, long-term holds become predictable. Now third, flips. This is where you're buying a property, renovating it, and reselling it for a profit. And flips thrive during expansion and peak demand cycles. When demand is strong and inventory moves fast, margins can be excellent. But when the market shifts, this is usually the first place that risk increases. Fourth, tax liens and deeds. This is one of the most overlooked strategies. You're investing in properties tied to unpaid taxes, and this tends to increase during tightening markets, when more people begin falling behind. For analytical, research-driven investors, this can be a powerful lead. And fifth, creative financing. Instead of owning the property, you own the debt behind it. This becomes especially interesting in distress cycles, because the opportunity is often in the terms of the deal, not the house itself. So here's the real takeaway. There isn't one strategy, there's a toolbox. And the people who build real momentum aren't the ones chasing the newest tactic. They're the ones who understand what works, when it works, why it works, and what this market is rewarding right now. So instead of asking, what's the best strategy, start asking, what strategy fits this market cycle and where I am right now? That question changes everything. And that's exactly what Seminar Insider is built for. Not just to show you strategies, but to help you understand when and why to use them, so you can capitalize in every cycle. In the next video, I'm going to show you how deals actually work, the numbers behind them, and how real investors evaluate opportunities in different markets.